Okay, let's unpack this.
Mm-hmm.
Today we're doing a deep dive into the Market Intelligence Report for July 29th, 2025. The end of day stuff.
Yeah, that was quite a day, wasn't it? Lots going on beneath the surface.
It really was. Because you might have seen the headlines,
Mm.
Screaming new record highs. Sounds great. Cause for celebration.
Right, very celebratory on the surface. Looks like everything's fantastic.
Exactly. But what does that really mean when you, dig into the details? That's what we're here for.
That's the key question, always. What's the real story?
So our mission today is to get past those surface-level numbers, find the important nuggets of knowledge, help you understand the true forces at play.
Because it was a fascinating day, a real study in contrasts, as you said.
Yeah, a market of contradictions. That's a good way to put it. Where headline indices hit records, but underneath,
Yeah,
a cautionary tale.
definitely. What's so interesting is how that data presents such a bifurcated picture, two
Yeah.
completely different realities almost. And understanding not just what happened, but why it mattered, that reveals a much more complex narrative. Tells you about the market's health, its direction.
So let's start right there. The headline versus the reality. This market of contradictions.
Good place to start.
Because when you looked at the major stock market indices on July 29th, it really was like a tale of profoundly different experiences.
Highly different, yeah.
You had the headlines boasting about new records, but the reality, far more nuanced, fragile even.
Fragile's a good word.
Take the S&P 500, the big benchmark everyone watches.
Right.
It finished virtually unchanged, up, 1.13 points? Just
Wow.
0.07%?
Right.
Closed at 6,389.77.
Everything moved?
Exactly. Now, technically, yeah, that was its sixth consecutive record close.
Technically.
But gaining only a single point, that's a record with, zero momentum. A clear loss of upward thrust, like he was just nudged over the line.
No real conviction behind it, not that broad, decisive move you associate with, real market health.
Not at all. And the divergence from that flat S&P performance was immediate.
Striking. Absolutely. You look straight at the NASDAQ composite, heavily weighted towards technology, obviously.
Right.
That was the session's clear outperformer, gained a pretty solid 70.27 points. That's 0.33%. Hit a new record, too, 21,178.58.
So, much stronger there. Why?
Well, it was largely down to very specific drivers. There was a surge in positive sentiment around semiconductors.
So, with the chip stocks?
Yeah, and just the continued strength in those select few large-cap tech components, the ones that have been driving things for a while now.
The usual suspects?
Pretty much. So this tells you straight away, market strength wasn't uniform. It was concentrated. Very specific areas, a real imbalance.
And that imbalance becomes even clearer when you look at the Dow Jones Industrial Average. 30 blue chips.
Another story entirely there.
Totally. It's significantly lagged. Slid 64.36 points, that's 0.14%, down to 44,837.56.
So the opposite direction of the NASDAQ, essentially.
Right. And this wasn't some broad weakness hitting all 30 stocks. It was mainly severe weakness in key components, healthcare and industrials specifically.
Any names stand out?
Oh, yeah. We're talking giants like United Health Group.
Yeah.
And Merck.
Oof, big players.
Huge. And they both had really disappointing earnings reports that day, weighed heavily on the index.
So individual company news really tanking that average.
Exactly. So right from the top, you've got this picture. S&P barely making a record, NASDAQ soaring on tech, Dow getting hammered by a couple of big losers.
Yeah. That immediate trio of divergent performances, it just screams that this wasn't a healthy, broadly supported market. Not at all.
It underscores that selectivity, doesn't it?
Perfectly. And that selectivity is precisely why we need to go beyond those surface numbers. Celebrating headline records can easily mask these underlying realities that demand a much closer look.
Which brings us right to what those headlines masked. Peeling back the layers, looking at the market's pulse.
The internals.
Because when you dug into the internals on July 29th, the foundation, well, it looked a lot less stable, indicative of what people are calling a hollow rally.
That's a really crucial distinction, that hollow rally concept. If you picture a healthy rally as, broad, lots of stocks participating, moving up together.
Right. A rising tide lifts all boats.
Exactly. July 29th was not that. It presented a vastly different picture.
Right.
Let's start with trading volume.
Okay.
Total volume across U.S. exchanges was 17.58 billion shares. Now, that sounds like a big number.
Seems substantial, yeah.
But it was actually below the recent 20-day average, which was 17.84 billion shares.
Okay, so lower than usual participation.
Lower than recent average, yeah. And this isn't just, a minor blip, below average volume when prices are at elevated levels, like record highs.
Hmm.
It suggests a lack of widespread conviction,
Fewer people buying in at these prices.
or at least limited institutional enthusiasm,
Okay.
limited follow-through buying. The smart money wasn't necessarily piling in with conviction saying, yes, these new highs are justified, let's go higher.
Gotcha. That lack of broad participation signals fragility.
Often, yes, it can be a sign of fragility.
And that fragility or lack of conviction was really hammered home when you looked at market breadth.
Oh, definitely. Breadth was decidedly negative.
Explain breadth quickly for us.
Sure. Market breadth just measures the number of stocks going up versus the number going down, gives you a sense of how widespread the market move is.
Okay. And it was negative.
Very. On the New York Stock Exchange, decliners outnumbered advancers by a ratio of 1.81 to 1.
Wow, almost 2 stocks falling for everyone rising.
Exactly. And the NASDAQ wasn't much better. Similar ratio, 1.48 to 1 decliners to advancers.
So even though the NASDAQ index itself was up,
More individual stocks listed on the NASDAQ were actually falling.
that's a classic bearish divergence, isn't it?
Textbook definition. It's a significant warning sign. Headline indices like the S&P and NASDAQ might be rising, maybe hitting records,
Yeah.
but the vast majority of individual stocks, the army behind the generals, are actually falling back.
Like the main engines are firing, but most of the smaller thrusters are sputtering.
Great analogy. And historically, these kinds of divergences have often preceded market weakness, or even corrections.
Okay, so negative breadth, lower volume. What about volatility? The VIX.
Right, the VIX, the CBOE Volatility Index, often called the fear gauge. It actually remained in a pretty subdued range, hovering around 14.85. It had closed Monday just over 15, so slightly down.
So not much fear. That seems contradictory.
It does seem contradictory on the surface. It indicated a low level of immediate fear. But crucially, it also showed a slight upward bias during the day.
Okay.
Analysts were calling it palpable pre-Fed jitters. So while there wasn't outright panic, there was definitely this undercurrent of unease, a quiet tension building ahead of the Federal Reserve's policy decision the next day.
So low VIX, but maybe. Complacency mixed with anxiety.
That's a good way to put it. Complacency rather than genuine strength combined with that pre-Fed nervousness. That combination of low VIX with really negative breadth is often seen as a sign of market complacency, not strength.
Gotcha. So put it all together. Record highs on the indices.
Yep.
But notably, negative market breadth
Big divergence.
and below average trading volume.
Right.
It all points strongly to this idea of a hollow rally or a narrow rally.
Exactly. And the key takeaway for you listening is the fragility this introduces.
How so?
Well, that broad market strength becomes kind of illusory. Your portfolio's perceived safety, if you're just looking at the index, could be undermined if just those few leading stocks falter.
Because it's not the whole market rising together.
Precisely. It's not a rising tide lifting all boats. It's a scenario where a small group of heavily weighted mega-cap stocks, mostly in tech, are disproportionately driving the performance of those market cap-weighted indices like the S&P 500 and NASDAQ.
Like a parade where only the lead floats are moving forward while everyone else is stuck. Creates a misleading picture.
Perfect analogy. And we have clear, quantifiable evidence of this narrow leadership.
Which is,
Look at the equal weight version of the S&P 500. This version gives every stock the same importance, regardless of its size.
okay, so it neutralizes the effect of the mega caps.
Exactly. And that equal weight S&P 500 was actually down 0.6% on Monday.
Down, while the main S&P was flat to slightly up.
Right. This directly contradicts the cap-weighted index performance and provides undeniable proof that the rally wasn't broadly supported. Most stocks were actually falling.
That's stark.
It is. And this market structure, it's inherently fragile. It becomes highly susceptible to sharp reversals if those few leaders stumble or falter.
Because there's no broad base of support underneath to cushion the fall.
Exactly. So it raises a really important question for you, the listener. How robust can a rally truly be when it's not broadly supported?
Right, it's like building a skyscraper on just a few strong pillars while the rest of the foundation is weak. It might stand for a bit.
But the risk of instability just grows and grows. This dynamic really demands a hyper-focused approach, looking at individual company health, not just relying on the index.
That's a powerful analogy. And understanding this underlying fragility, it leads us straight to the bigger picture. The macroeconomic and geopolitical landscape, that was really dictating investor sentiment on July 29th.
Absolutely. Because this wasn't happening in a vacuum. Investor sentiment was shaped by this really complex interplay. Domestic monetary policy anticipation on one hand.
The Fed?
the Fed, and crucial international trade developments on the other. It really was like watching a multi-dimensional chess game playing out globally, every move having ripples.
And the main event, the big elephant in the room that colored everything, was the Federal Reserve meeting.
Dominated everything, yeah, the FOMC.
The Federal Open Market Committee, they started their highly anticipated two-day policy meeting. The decision on interest rates was coming the next day.
Right, high anticipation.
Now, the market consensus was pretty clear. The Fed was expected to hold its benchmark rate steady, keep it in that 4.25% to 4.50% range.
Yeah, almost zero probability priced in for a change on that day.
So the suspense wasn't really about the rate decision itself.
No, not at all.
Instead, investors were laser-focused on the language, the wording in the accompanying policy statement, and any forward-looking guidance about future rate cuts, timing, pace.
That's where the real signals would be. About the economic outlook, the Fed's intentions, that's what everyone was waiting to dissect.
And the Fed was in a really tough spot here, right? Balancing all this mixed economic data.
Incredibly difficult spot. On one side, you had data suggesting resilience. The JOLTS report on job openings, consumer confidence figures, both pointed to a remarkably strong labor market, a healthy consumer.
Which argues against cutting rates soon.
Potentially, yes. A strong labor market can lead to wage growth, which could contribute to persistent inflation, that whole wage price spiral concern.
But on the other side,
Well, you had the S&P case Schiller Home Price Index showing a noticeable slowdown in annual gains. Some fatigue in the housing sector, which is very sensitive to interest rates.
okay, so mixed signals from the economy itself makes their job harder.
It's extremely. Data pulling in different directions, arguments for staying vigilant on inflation, arguments for maybe needing to ease policy down the line.
And then you throw in the political dimension.
Always a factor, isn't it?
President Trump had been continuing his public pressure on the Fed, calling for rate cuts to stimulate growth even further.
Right. Which puts the Fed in that incredibly delicate position, navigating what you could call an impossible trinity of policy objectives.
Okay, break down that impossible trinity for us.
Sure. Objective 1, inflation vigilance. They have to remain watchful against any resurgence of inflation, especially with that strong jobs and confidence data we just mentioned. Can't let inflation expectations become unanchored again.
Makes sense. Objective 2.
Political pressure. They face this overt public pressure to cut rates, which challenges the perception and the reality of central bank independence. Caving to political demands erodes credibility long term.
Right, a very fine line to walk. And the third objective,
Assessing the unpredictable impact of the new tariff regimes. The new US-EU tariffs, for example. They're lower than threatened, 15% on most goods instead of 30%.
okay, better than expected, but
But they're still inflationary by nature. Tariffs raise the cost of imported goods. That can push prices up for consumers or squeeze business margins, creates a huge forecasting challenge for the Fed.
how do you set rates when trade policy could suddenly push inflation up or down independently?
Exactly. So picture being the Fed, persistent inflation worries, direct political heat, and the unpredictable ripple effects of trade policy, all pulling in different directions.
No easy answers.
None at all. Which is why, as one analyst put it, the Fed's statement the next day would be scrutinized with extreme prejudice, every single word, every comma, looking for shifts in tone.
So what were the potential scenarios the market was bracing for?
Basically, two critical scenarios traders were pricing in. First, a hawkish hold, meaning a statement that acknowledges the economic strength, highlights those tariff-related inflation risks, but offers no hint or even actively downplays the urgency of future rate cuts.
And the market reaction to that?
Likely disappointment, a risk-off move, stronger dollar, pullback in stocks, especially growth stocks. Bonds might sell off too, pushing yields higher.
Okay. And the alternative?
The dovish hold. This would be a statement that maybe overemphasizes downside risks to the economy, or perhaps subtly signals that a September rate cut is a real possibility.
How would that play out?
That would likely ignite a broad risk-on rally. Weaker dollar as rate expectations fall. A surge in interest rate-sensitive assets, think gold. Many tech stocks. Bonds would likely rally too.
So the market's cautious, quiet trading on the 29th.
Was a direct reflection of this profound uncertainty. The high stakes involved in guessing the Fed's precise tone, everyone was just waiting, holding their breath.
And it wasn't just the Fed dominating the macro picture. International trade dynamics, geopolitics, they were huge factors too.
Absolutely critical. Markets were still actively digesting that new US-EU trade framework, the one that managed to avert the big tariff escalation.
That was seen as a positive, right?
Generally, yes, a relief. The key detail was the 15% U.S. import tariff on most EU goods, much lower than the threatened 30%.
Okay.
But the deal also included this landmark commitment from the EU, a promise to purchase $750 billion worth of U.S. energy and significantly to invest heavily in American infrastructure.
Wow, $750 billion in energy purchases.
Massive number, and that was a primary catalyst for the rally we saw in energy stocks and crude oil prices. It signaled huge, guaranteed future demand for U.S. energy exports, a clear tailwind for that sector.
Gotcha. So that trade deal had very direct market impacts.
Very direct. And that wasn't the only critical trade negotiation happening.
Right, the U.S.-China talks.
Exactly.
Yeah.
High-stakes talks were continuing in Stockholm. U.S. Treasury Secretary Scott Bessent, Chinese Vice Premier He Lifen.
And there's a deadline looming there, too.
A critical August 12 deadline, with the very real threat of a return to triple-digit tariffs if they don't reach an agreement. That outcome remained a major source of market uncertainty.
A breakdown there could trigger another trade war scare.
Easily. Impacting global supply chains, earnings, growth, the whole 9 yards. Huge stakes for the global economy.
And then there were these broader geopolitical undercurrents adding to the complexity.
Yeah, just layering on the uncertainty. You had President Trump's shortened deadline for Russia to end the war in Ukraine, implications for energy, global stability, and growing concerns within NATO about China's strategic infrastructure investments across Europe, seeing them as potential tools for political leverage, maybe reshaping alliances and trade routes down the line.
So many moving parts globally.
It's incredible. And if you connect all these threads, the trade deals, the tensions, you see how these global shifts create significant headwinds and tailwinds. They reverberate through every market sector.
It's not just about domestic policy.
Yeah.
The world stage plays a huge, unpredictable role.
Enormous. And understanding these forces helps explain why July 29th was anything but simple.
Okay, so with all these macro currents swirling, the Fed anticipation, the trade deals, the geopolitics, how did different parts of the economy, the different sectors actually fare? Because you said it was a stock picker's market.
It really was. The sector performance map for the day clearly illustrated that bifurcated market we talked about. Company-specific news, sector-specific catalysts, they were paramount.
Not just everything moving together. Not risk on or risk off.
Emphatically not. We saw a very clear split. On the leading side, you had sectors with distinct positive catalysts really shining.
Like technology.
Technology, yeah. XLK, the sector ETF, buoyed by stellar earnings from semiconductor firms. We mentioned Amkor Technology earlier. Also, Commvault Systems had a great report.
So specific company news lifting the sector.
Absolutely. Signaling robust demand in their niches. Plus, you had that continued optimism around AI spending, especially after Alphabet's recent capital expenditure increase. Suggests that whole AI investment cycle is still strong.
So if there was a compelling growth story, investors were still buying.
Exactly. They were willing to participate, drive prices higher, if the fundamentals and future demand looked solid.
What else was leading?
Industrials, XLI, lifted partly by a strong report from Boeing, always moves the needle. And also that optimism around infrastructure spending tied to the EU trade deal, billions potentially flowing into U.S. projects.
Makes sense. And energy, XLE.
Remained exceptionally strong. Built on Monday's gains, crude prices rallied again thanks to those huge EU energy purchase commitments in the trade deal, basically put a floor under future demand.
Got it. What about financials, XLF?
More mixed, but leaning positive. Got a big boost from SoFi's earnings. We'll talk more about them later. But there was definitely some underlying caution across the broader sector ahead of the Fed. Uncertainty about rates always impacts banks and financials.
Okay, so tech, industrials, energy leading. Now the other side of the ledger, the laggards.
And here you see a completely different, often challenging story. Healthcare XLV was the day's worst performer, by a wide margin.
Why so bad? Was it a broad sector issue?
No, not really systemic. It was dragged down by truly disastrous earnings and guidance cuts from some giants. United Health, Merck, like we mentioned.
All right.
And then Novo Nordisk, NVO,
Yeah.
a stunning 22% plunge.
22%. For a giant like Novo Nordisk.
Huge drop. Shocked the market. We'll get into the details later, but that alone created this massive negative ripple effect across the whole sector. Shows how concentrated impacts can weigh disproportionately.
Wow. Okay, so healthcare hammered. What else lagged?
Well, the interest rate sensitive sectors, naturally, real estate, XLRE, and utilities, XLU, they remained weak, reflecting those ongoing worries about the Fed and potentially higher rates for longer. Directly hits their borrowing costs.
Makes sense. Materials.xlb.
Also economically sensitive, took a hit. Nucor, the steel company, slumped on a revenue miss, and concerns over metal tariffs were still lingering. Direct link between policy and performance there.
Consumerdiscretionary.xly. That's usually sensitive too.
Mixed to negative, actually. You had Whirlpool plummeting. We'll touch on why. But Carnival, the cruise line, showed some resilience. Maybe reflects different types of consumer spending goods versus experiences.
Interesting split there. And consumer staples.xlp, usually defensive.
Traded negative. Just reflecting that general market caution, maybe. Plus, big names like Procter & Gamble hadn't reported yet, so maybe a wait-and-see approach there, too.
So this divergence, it just hammers home the need for granular analysis, doesn't it?
Absolutely critical. You couldn't just buy a sector ETF and assume you knew what was happening. The specifics driving individual companies were everything, truly a stock picker's market. You had to identify the catalysts, avoid the landmines. Broad trends weren't helpful because most boats were actually sinking or stuck.
Okay, let's really bring this divergence to life then. Let's look at the specific stock stories, the individual companies that dominated the headlines, the biggest movers, gainers, and laggards.
Yeah, this is where the micro-level detail gets really fascinating, reveals the potent impact of that company-specific news.
Let's start with the gainer circle. Who was flying high?
Top of the list, Newegg Commerce,
Yeah.
Venti, up a staggering 39.25%.
Wow. What drove that? Amazing earnings.
Not earnings, actually. It was driven by an SEC filing, a Form 4.
And insider filing.
Exactly. It revealed significant insider purchases. Directors and 10% owners, Vladimir and Angelica Gulkin, bought a huge chunk, 138,757 shares for about $5.8 million.
That's a massive buy.
Huge. Boosted their direct stake to over 3.3 million shares, or 17.1% of the company.
Yeah.
Such a strong signal of insider confidence, especially in a heavily shorted stock like Newegg.
The short interest.
Right. It very likely triggered a powerful short squeeze. All of those betting against the stock were forced to buy back shares to cover their positions, pushing the price up even faster.
Talk about a vote of confidence from the inside. Okay, who else?
XPro Group, XPRO energy services firm, rocketed up nearly 32%, almost 31.9%.
Why them?
They reported Q2 earnings that just crushed analyst expectations. Adjusted EPS of 30 cents versus a 19-cent consensus. Huge beat. Plus, they announced $595 million in new order awards showing strong future business. They reaffirmed their strong full-year guidance, and they committed to shareholder returns through buybacks.
Wow, the trifecta. Strong results, strong outlook, giving cash back.
Exactly. A trifecta of positive news. Everything investors love to see.
Okay, another big gainer.
Sanmina Corp.
Huh?
SANM, Electronics Manufacturing Services. Gapped up over 23%.
Another earnings beat.
Yep. Fiscal Q3 results beat on both revenue, $2.04 billion, and non-GAAP EPS, and $1.53. Now, their Q4 revenue guidance was actually slightly below consensus.
Oh, but it still rallied hard.
It did, because the magnitude of the Q3 beat was so significant and management sounded really confident about momentum carrying forward. That current strength seemed to outweigh the slightly cautious guidance.
Interesting. Shows how sentiment plays a role, too. What about tech gainers?
Commvault Systems, CVLT, data protection company. Shares soared almost 19%.
Why? Stellar report.
Absolutely stellar Q1 fiscal 2026 report. Beat revenue and EPS estimates. Driven by record total revenue of $282 million, up 26% year over year. And get this, a remarkable 66% surge in their SaaS revenue, software as a service.
66% SaaS growth. That's huge.
Phenomenal. And crucially, they raised their full-year revenue guidance, signaled sustained demand for their cyber resilience platform. That's what really gets tech investors excited. Not just current strength, but strong future outlook.
Definitely. Anyone else in tech shine?
MCore Technology. AMKR semiconductor packaging jumped nearly 19% too.
Strong results there as well.
Strong Q2 results, robust Q3 guidance. Q2 EPS of 22 cents beat the 16-cent estimate. Revenue $1.51 billion, also a beat. And management explicitly cited powerful demand in the artificial intelligence, AI, and high-performance computing HPC market.
Ah, the AI connection again.
Crucial connection. That, plus a Q3 revenue forecast well above consensus, led to multiple analyst price target upgrades. Shows the ripple effect of AI demand through that supply chain.
Okay, so some really powerful upside moves driven by specific news. Now, the other side of the coin. The laggards list.
And there's some very big names here, taking some serious hits.
Who led the decline?
Novo Nordisk, NVO. The pharmaceutical giant we mentioned earlier, stock collapsed a stunning 21.37%.
21%. What was the catalyst?
They lowered their full-year sales and profit outlook, specifically cited an expected slowdown in U.S. growth for their blockbuster obesity drug, Wegovy.
Wow. Slow down for Wegovy. That drug was on fire.
Exactly. The news shocked investors, as reports said. Given the prior euphoria and sky-high expectations around Wegovy's potential market penetration, this didn't just hit Novo Nordisk hard, it cast doubt over the whole weight loss drug market's growth sustainability.
Huge implications.
Okay.
Who else got hammered?
Whirlpool, WHR, the appliance maker, shares capsized over 14%.
Why? Bad quarter.
Missed Wall Street expectations on their quarterly results, yes, but they also slashed their full-year guidance, and management specifically blamed the negative impact of U.S. tariff policy.
A direct hit from tariffs.
Very tangible example. Shows how macro policy translates directly into corporate pain and investor concern, not just theoretical.
Right. More healthcare pain.
Yeah, Merck, MRK, plunged 7.8%. Their Q2 revenue missed estimates and actually fell 2% year over year.
Revenue falling year over year. That's not good for a pharma giant.
Not at all. Even though they slightly raised the low end of their earnings guidance, that revenue miss, combined with ongoing market challenges for some key drugs, it really spooked investors, highlights the competitive pressures.
And United Health? UNH, the other Dow component that dragged it down?
Dropped 5.1%. They also missed Q2 earnings estimates and trimmed their 2025 profit outlook.
Why they missed there?
They attributed weakness to rising medical utilization costs. People using more healthcare services, especially elective procedures, may be delayed during the pandemic.
Okay.
And their new profit forecast for 2025, at least $16 per share, was way below the $20 analyst consensus, raised serious concerns about profitability across the entire managed care sector, shows how problems at one giant can signal industry-wide issues.
So these individual stories, earnings, insider buying, policy impacts, they really paint that picture of selective engagement, don't they?
Absolutely. Reinforces that idea that understanding micro-level catalysts was crucial. Often completely overrode broader market trends that day. Way more insight from these details than just index movements.
Okay, let's broaden out again. Beyond stocks. What about commodities and currencies on July 29th? They often reflect those broader economic and geopolitical shifts.
They certainly did that day. Energy markets, for instance, saw that significant rally we touched on, built on Monday's gains of over 2%.
WTI and Brent crude both up.
Yep. West Texas Intermediate WTI climbed towards $69.45 a barrel. Brent crude, the international benchmark, rose towards $70.93.
And the main driver was still that U.S.-EU trade deal.
Primarily, yes. That massive commitment from the EU to buy U.S. energy was interpreted as a huge future demand driver. A significant, steady increase in demand implied. Provides that long-term tailwind.
Any other factors supporting oil?
Ongoing geopolitical tensions involving Russia always add a layer of supply uncertainty, which tends to support prices too.
Got it. And it wasn't just oil, right? Natural gas too.
Natural gas had a notable jump too. Front-month NYMEX futures rose over 3% to settle at 3.081 per million British thermal units, the MMB2. That was its largest single-day percentage gain since mid-July.
So broad strength across the energy complex, linked to trade, geopolitics.
Exactly. That increased European demand for U.S. energy isn't just crude, it benefits natural gas too, especially given ongoing concerns about European energy security.
Okay. Now, in contrast to that energy surge, precious metals, gold and silver.
Much more subdued there. Gold futures saw just a modest rise, about 0.4%, trading around $3,325 an ounce. Kind of a slight recovery after falling for a few days.
And silver.
Broadly unchanged, near $38.16 per troy ounce.
Why so quiet there when energy was popping?
Classic sign of a market waiting for a major catalyst. Investors were hesitant to take big new positions right before that FOMC decision.
Because gold and silver are sensitive to interest rate expectations.
Highly sensitive. As non-yielding assets, they become more attractive when rates are expected to fall. The opportunity cost of holding them goes down. A dovish signal from the Fed could ignite a rally.
But a hawkish tone could send them lower.
Precisely. So that quiet, range-bound trading just reflected profound uncertainty about what the Fed was going to signal. Everyone was on the sidelines.
Makes sense. And finally, currencies. The U.S. dollar.
The U.S. dollar index, the DXY, which measures the dollar against a basket of other major currencies, it actually held firm, traded up about 0.44% to 99.06.
Dollar strength. How did that impact things?
Well, a stronger dollar acts as a headwind for dollar-denominated commodities, especially gold. It makes things priced in dollars more expensive for buyers using other currencies, potentially dampening demand, so that likely capped gold's potential gains.
So what does this all mean? It really underscores how interconnected everything is,
Absolutely. A trade deal impacts energy demand,
which affects commodity prices.
which interacts with currency movements.
And all of it is dancing to the tune of central bank anticipation.
It's a truly complex web of cause and effect. Understanding these interdependencies is key to making sense of daily market moves beyond just the stock indices. It really highlights that the financial world is one integrated system.
Okay, building on that, let's look at the technical picture, the charts for the broader market, and then maybe zoom in on some specific breakout opportunities that stood out despite the overall caution.
Sounds good. From a pure technical perspective, the S&P 500 itself, it still remained in a clear uptrend, trading comfortably above its key moving averages, the 50-day and the 200-day.
So the longer-term positive trend was intact.
Technically, yes. However, the recent price action was definitely showing those classic signs of exhaustion we talked about.
Like what?
Well, the Relative Strength Index, RSI, it's a momentum gauge. It was in overbought territory, suggesting the rally might be running out of steam short term.
Okay.
And more significantly, those negative divergences. The index hitting new highs while breadth and volume were weakening. That's a major warning sign for technical analysts. Signals a lack of underlying strength.
So what would technicians expect or even want to see next?
Well, for the overall health and sustainability of the rally, a near-term pullback wouldn't be surprising. Maybe a test of the 20-day moving average, which was around the 6260 level.
And that would be considered healthy.
Potentially, yes.
Yeah.
Healthy and unsurprising. It could alleviate some of those overbought conditions, shake out some weaker speculative positions, and maybe set the stage for a more sustainable advance later. Build a firmer base.
Like the market needing to catch its breath before climbing higher, or just consolidate those gains.
Exactly.
But even with that cautionary technical backdrop for the broad market, there were individual stocks just screaming, breakout,
Yeah.
showing strong, isolated conviction.
Absolutely. Rewarding those who looked beyond the general index. And our breakout stock of the day really highlights this. SoFi Technologies, ticker SoFi.
Ah, yes, the financials name that bucked the caution.
It was a compelling example.
Yo.
Strong fundamental and technical catalysts aligning perfectly.
Remind us of the fundamental catalyst again.
Stellar Q2 report. Far exceeded analyst expectations. Beat on revenue $854.9 million versus the $809 million estimate. Beat on EPS 8 cents versus the 6-cent estimate.
Strong numbers.
Plus, record member growth hit 11.7 million users, accelerating customer acquisition, and, most importantly, management raised their full-year guidance, both revenue and earnings. Powerful signal of confidence.
Okay, strong fundamentals. How did that translate technically?
Provided the absolute fuel for a powerful technical breakout, the stock surged over 16% on the day.
60%.
On massive trading volume, 192 million shares. That's nearly triple its average volume.
Huge participation in that move.
Exactly. And this price action created a powerful breakaway gap on the daily chart, gapped up significantly at the open and never looked back.
Why is a breakaway gap significant?
Because this type of gap, especially when it happens on heavy volume and is driven by a strong fundamental catalyst like that earnings report, it often marks the beginning of a new sustained uptrend, not just a fleeting spike that might get filled quickly. It suggests a real shift in market perception.
Okay, so where might support and resistance be now for SoFi?
Well, that previous resistance area, around $20, $21, that's now likely to act as a new floor of strong support. Prior sellers might become buyers there.
Makes sense. And upside.
The next key level to watch is probably the psychological $25 mark, which also happens to align with its 52-week high, so potential for continued momentum towards that level.
Interesting. SoFi showing real strength. Any other technical observations or breakouts?
Yeah, a couple others stood out. Carnival, CCL, and Toast. 2OST. They were both identified as breakout stocks, hitting fresh 52-week highs that day.
Supported by fundamentals, too.
Seemed to be. Carnival likely benefiting from that resurgent travel demand, consumers still prioritizing experiences. Toast involved in AI-driven restaurant technology, showing how tech innovation is hitting various industries.
Okay.
And one more. Williams-Sonoma WSM, the home furnishings retailer. Technical analysis suggested it had entered a bullish phase. It recently found solid support at a cluster of key moving averages.
Meaning buyers stepped in at those levels.
Right, robust buying interest. And its RSI reading confirmed a bullish trend, looked technically poised to potentially retest its all-time high, continued strength in that higher-end consumer space.
So it really shows the power of combining that fundamental analysis with the technical signals, doesn't it?
Absolutely. It's not just about what a company reported, but how the market reacted to it on the charts, and what that reaction might signal for the future price. Powerful combination for finding opportunities, even when the broad market looks tired.
Okay, so July 29th, a really fascinating study in market dynamics. Contradictions, subtle signals, rewarding that deeper look. But critically, it was also just the prelude, right? Setting the stage for what promised to be an even more impactful day.
Absolutely. Wednesday, July 30th, was poised for potentially extreme volatility, dominated by that FOMC policy decision and just a torrent of corporate earnings reports. This wasn't just another trading session. It was set to define the market's tone for potentially the rest of the summer.
And the single most important catalyst for Wednesday, no question, the FOMC policy decision. 2.000 Eastern Time.
The main event, everything else leads up to that.
And as we established, the market wasn't expecting a rate change. Zero probability priced in. So all focus was on
The language, the precise wording of the policy statement, any hints about a potential September rate cut. The market was going to dissect every syllable, looking for clues about growth, inflation, the Fed's overall stance. It's all about what comes next.
creating those two distinct high-stakes scenarios we discussed.
Exactly. Scenario 1, the dovish hold. Fed strongly signals a September cut is likely, maybe emphasizes risks, notes progress on inflation,
Market reaction?
broad risk-on rally, weaker dollar, surge in gold, growth stocks, bonds rally, yields fall.
Scenario 2, the hawkish hold.
Fed emphasizes persistent inflation, economic resilience, downplays the urgency of cuts.
Market reaction.
Risk-off move, stronger dollar, market pullback, especially growth stocks, bond yields likely rise, defensive sectors might outperform, high-stakes decision on tone.
But before the Fed announcement at 2 p.m., there was other important stuff happening in the morning, right? Economic data.
Oh yeah, critical data releases setting the stage. At 8:15 a.m. Eastern, the ADP non-farm employment change, key preview of Friday's official government jobs report.
How could that move markets?
A number significantly stronger or weaker than expected could shift rate expectations before the Fed even speaks. Give clues about the labor market's health.
Okay. Then just 15 minutes later, 8:30 a.m.
Advance Q2 GDP, the first official look at second quarter economic growth.
Huge number. What were the implications?
A strong print reinforces that resilient economy story. Maybe gives the Fed cover to be more hawkish. A weak number intensifies pressure on the Fed to signal rate cuts are coming soon. Fuels the dovish hopes.
Gotcha. Anything else data-wise?
Later in the morning, 10:30 a.m., crude oil inventories. Directly impacts oil prices and energy stocks, obviously. Key indicator of demand and supply there.
Okay, so a busy morning of data setting the scene for the Fed, and then earnings season continues full steam ahead.
Peak earnings season, yeah. And Wednesday was another massive day. Particular focus on some of those magnificent 7 tech giants.
Who was reporting after the bell on Wednesday?
Microsoft, MSFT, and Meta Platforms. Meta.
Wow. 2 behemoths.
Absolutely monumental. Their results, but maybe even more importantly, their forward guidance. Microsoft on AI spending and cloud growth. Meta on ad spend and metaverse investments. That would have a huge impact on the NASDAQ and broader market sentiment Thursday morning.
Because they're so heavily weighted in the indices.
Exactly. Their results alone can sway the entire market direction.
Any other key earnings reports expected Wednesday?
Yeah, a host of other influential companies. Qualcomm, QCOM, Automatic Data Processing, ADP, tying back to the Jobs Data Altria Group, MO, ARM Holdings, ARM, just a flood of information hitting the market.
So summing up the outlook for Wednesday, July 30th.
Poised for significant movement, sharp two-way price action likely, morning driven by GDP and ADP data reactions. But that's just the prelude.
To the main event, 2.00 p.m. FOMC announcement.
Which will set the market's direction for the rest of the week, maybe into August. All depends on the Fed's tone.
And then adding another layer, those after-hours earnings from Microsoft and Meta.
Right. Either confirming tech leadership or introducing new doubts. So traders needed to anticipate volatility. Be prepared for that fragile market equilibrium we saw on Tuesday to be decisively broken.
Key technical levels to watch.
Support for the S&P 500 still around that 20-day moving average near 6260. Resistance at the recent intraday high around 6389.
This is exactly why understanding these deep dives is so crucial. It's not just about reviewing what happened.
No, it's about understanding what it sets up for what's next, connecting the dots.
So let's try to synthesize this. What does it all mean? We've just taken this deep dive into July 29, 2025.
Revealed a day of these profound contradictions.
Yeah, headline record highs masking that underlying fragility,
Mm.
driven by very specific earnings, complex trade dynamics, that looming Fed decision.
It was a day that just highlighted the critical importance of looking beyond the headlines, understanding the nuanced signals the market sends rather than just reacting to the obvious noise.
Yeah.
The market really is a constantly evolving, interconnected puzzle. Understanding that interplay between the micro level company stuff, the macro policy, the global geopolitics, that's absolutely key to making any sense of it. Critical thinking is just essential, especially now with so much information overload.
And July 29th encapsulated that perfectly, the need to dig deeper.
It really did. Wasn't a simple story at all.
And it sets up some really interesting questions for all of us, for you listening.
Definitely. Here's something to think about. Given the Federal Reserve's impossible trinity of challenges balancing inflation, political pressure, tariff impacts, and given the market's clear, narrow leadership by just a few huge stocks, how might you adjust your own understanding of overall market health based on that? Does a record high mean the same thing in that context?
Good question.
And what does this suggest about the importance, maybe the increasing importance of doing that company-specific research versus just relying on broad market trends or index investing in the days and weeks ahead?
Something to mull over for sure, as we navigate what looks like a very eventful period ahead.